Hi there. This week, the US Treasury market was shaken. The yield on 30-year bonds surged past 5%, and some claimed Japan and China were dumping treasuries to strike back at Trump's tariff policies. But is that true? Let's calmly sort through what's fact and what might be just fear. First, did Japan and China really sell a large amount of US Treasuries? On April 9th, during Asian trading hours, the 30-year Treasury yield spiked. Bloomberg described it as a fire sale, and Reuters compared it to the panic selling seen during the early COVID crisis. So yes, the market was clearly shaken, but the very next day, a 30-year US Treasury auction showed surprisingly strong demand, especially from foreign investors. In fact, they bought even more than usual. Meanwhile, the most recent official TIC data, which tracks international capital flows, shows that as of January, both Japan and China slightly increased their holdings. In other words, while the fear was real, the actual evidence of large-scale selling is still missing. Now, could Japan and China sell treasuries to defend their currencies and apply political pressure on the US? In theory, yes. Tariffs can reduce exports and dollar inflows, weakening the yen and the yuan. To prevent sharp depreciation, central banks might sell dollars and buy back their own currencies. That dollar liquidity often comes from selling US Treasuries, and by selling enough, they could push US interest rates higher, raising borrowing costs for households and businesses and potentially putting pressure on policymakers. That's why some linked the bond turmoil to Trump's decision to delay tariff implementation by 90 days. But in practice, it's more complicated. The US Treasury market is massive. Daily trading can reach up to $1 trillion. Even $1.8 trillion Japan and China's combined holdings could be absorbed in a matter of weeks. Also, large-scale selling would hurt them too. It could drive down the value of their remaining holdings and trigger capital outflows if their currencies weaken too much. And remember, the Federal Reserve has tools. In 2020, during the COVID crash, the Fed stabilized the market by buying $370 billion in treasuries in just 1 week. Let's wrap it up. Yes, the market was rattled, but no, there's still no solid evidence that Japan and China launched a coordinated bond sell-off. So what should we keep an eye on? First, the TIC report for February will be released on April 16th. It will show whether Japan and China really started to reduce their holdings. If we see drops of more than $30 billion per month for several months in a row, that might suggest a meaningful shift. Second, watch Treasury auctions. If the share of foreign buyers, known as indirect bids, drops below 55%, that could indicate weakening international demand. And third, the 10-year Treasury yield. If it stays above 4.75% for a prolonged period, that could impact mortgage rates, corporate lending, and even political decision-making. In short, this week's market chaos was driven more by fear and rumor than by verified data. From here on, it's time to watch the numbers. This video was created using verified sources, including Bloomberg, Reuters, and official US Treasury data, with research and structuring assisted by artificial intelligence. Thanks for watching.